So a lot of people ask us, they send us messages, they DM us, they call our help desk. Andrew, Nomad Capitalist team, I just earned a lot of money this year. I've got a big tax bill coming up. I either don't have the money or I just don't want to pay it. It's so much money. What can I do to wipe out this year's tax bill for the income I've already earned? And generally speaking, this is where that saying, an ounce of prevention is worth a pound of cure. The answer for many people is, you should have called me a year ago. It's always the best time to put together a legal tax reduction strategy before you make money. So in this video, I'm going to elaborate on exactly who can get some of their money back from income already earned and why most people can't. Hi, I'm Andrew Henderson. This is pretty common, it's human nature. We're going out there, we're earning money, we just figure the tax bill, all the other stuff will be taken care of later. That was my story. I grew up this libertarian, people shouldn't pay so much in tax. These tax rates in the US are so high, but when I became 19 and I started my very first business, it was all about the income. It was always about how do I get more revenue. There wasn't much thought given to how do I make sure I don't get a big tax bill? And I've talked before about how seeing that first bill come in, it was a shock. Because it wasn't the 14-year-old libertarian who's only thinking in theories. Now it's real. You have to send this money or else you're going to be in big trouble. And so over the years, I've worked to figure out how to reduce my taxes. But in most cases, you really want to set up the structure going forward. I've talked before that if you can afford it, if you can justify it financially, setting up your offshore structure before the business even begins makes a lot of sense, because then you don't have any issues with transferring assets out, or you just start clean. But let's say you have a business and you've already earned some income. Can you move that offshore? Well, generally no. You can't even generally save money on tax in general because the income has been earned. Now we're speaking generally here because we're talking to people in many countries. But what people will do, let's say in the United States, is December 31st, end of the tax year comes around, and they will have more income than they expected, and they'll go out and they'll put a big expense on the credit card. They'll pay for the entire next year's media spend or advertising or whatever. And for a lot of people, that's really not even what you're supposed to do. But people do it, and some people get away with it. But that's not really the proper way. What I look at in the offshore world is, have you been overpaying? So recently somebody came to me and he had been paying some tax in the UK because he thought, well, hey, some of my business is in the UK, I'm just going to pay some tax. And it turns out he wasn't really supposed to be paying that tax, so we went back and we got him a refund. One of the big things that I see is someone will come to me and they'll say, Andrew, I've been paying $50,000 a year in the US. And then we'll look at their tax return. One of my CPAs will look at it and it'll be like, well, were you living in the US? No, I've never been there for the whole year. Why weren't you claiming the foreign earned income exclusion? Why weren't you taking that first $104,000, $106,000 tax-free? And they'll say, oh, well, my tax guy in the US never even thought about it. That's pretty common. When I first left the United States, I went to my domestic tax guy who did all the stuff for me when I was running my businesses in the US. And I said, hey man, make sure you take this foreign earned income exclusion. He said, no, you don't qualify. I said, what are you talking about? I've been here for like a week, for the whole year. And I had to fight with him and fight and fight. I said, finally, okay, fine, you're right. One of the most common pillars of offshore tax for Americans that we just take for granted was like the most complicated thing for him because it's not what he's used to. Most domestic tax preparers are domestic tax. They're domestic minded. And that's fine because that's where most of the market is. But when you go internationally, there's perhaps a chance that you're overpaying. And so in that case, if it's the end of the year and you have a tax bill, there might be a foreign earned income exclusion you can take if you are an American. What we also see with folks, and I had this recently, the guy left Australia in February and he was earning all this different money, and what we were able to do is go back and say, well, he actually declared his intention to leave Australia in February, so even though he's been earning this money, let's claim that he's non-resident for tax purposes. And again, that's where proper planning is important, because you're going to have a hard time claiming that you're not a resident for tax purposes if all your money is flowing into your country, if that's the bank account you're using, if your salary's going there, if your company's there, if you're a director of your company. People oftentimes don't plan for that stuff. They talk, as we discussed in another video, they'll just move their company to an offshore jurisdiction and then not do the non-resident part. But in general, what's happened has happened. If there's something that has been overlooked, if you shouldn't have been tax resident in your country, if perhaps there's some income in your company that could be allocated somewhere else, and we can do an income allocation and say, well, hey, this part of the income isn't local source. Let's move that over here. Let's exclude that from tax. If you qualify for some kind of exemption, if you're an American, those are all ways where you may not have realized that you were eligible for some kind of relief based on you personally or based on where the business is being run. But in general, when someone comes to me, I'm saying, let's start with today. Let's get that tax rate to 0% or 2% or 5% or 10% or whatever we can do, whatever you're comfortable with, whatever's possible. Let's do that so that today, the next month, the next year, 10 years from now, you can save a lot of money. Let the past be the past. We'll review the past, we'll see, and make sure there's nothing missing there. And a lot of times we'll find, yeah, there's some low-hanging fruit. There's something missing, something that you forgot to deduct, an exemption you forgot to take. But barring that, you need to look to the future and realize that the bad structure you may have had in the past probably won't help you save tax.
I'm Andrew Henderson, and if you're looking for a way to legally reduce your taxes, build your freedom, and create wealth faster as a global citizen, then you've come to the right place. I want you to do 3 things right now. Number 1, click the button to subscribe to our channel. Make sure to get notifications so you never miss a new video. Number 2, get a copy of our #1 best-selling book, Nomad Capitalist, on Amazon, and learn all of the dozens of benefits of our lifestyle. And number 3, if you're already a 6- or 7-figure entrepreneur and you want to put these strategies in place, go to nomadcapitalist.com and find out how to get some help.